Hello everyone, and welcome back to the channel where we demystify the complex world of finance. Today, we're diving deep into a fascinating microcap stock that has popped up on our hard-to-bar screener, Wearable Devices Limited, ticker symbol WLDS. We're going to break down why this stock is drawing attention from short squeeze enthusiasts and what all those high numbers actually mean for you. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, let's talk about WLDS. Wearable Devices Limited operates in the exciting technology and consumer electronics sector. They are innovators in developing a non-invasive neural input interface, essentially allowing you to control digital devices using subtle touchless finger movements. Imagine controlling your smartwatch or other electronics with just a flick of your finger, no touching required. Their modular development kits are at the forefront of this technology. With a market capitalization of just $7 million, WLDS is firmly in microcap territory, which often means higher volatility and unique market dynamics. What is cost to borrow and why it matters? Before we get into the specifics of WLDS, let's quickly explain one of the most critical metrics for short squeeze potential, cost to borrow, or CTB. When a short seller wants to bet against a stock, they first have to borrow shares from a broker. They then sell those borrowed shares, hoping to buy them back later at a lower price and return them, profiting from the difference. The cost to borrow is the annualized interest rate they pay to borrow those shares. It's essentially a rental fee. When this fee is very high, it indicates that shares are scarce, and demand to short is strong, making it expensive to maintain a short position. This can create significant pressure on short sellers. It's not uncommon for these fees to exceed 100% annualized in extreme cases, reflecting a true supply-demand imbalance in the borrow market. Why this stock is hard to borrow right now. Now, this is where WLDS gets particularly interesting. According to our data, the cost to borrow fee for WLDS is a staggering 949.3% annualized. That's nearly 1,000% per year just to hold a short position. To put that in perspective, typical CTB fees for most stocks are in the single digits. This extremely high fee tells us a few things. Shares of WLDS are very hard to find and borrow, and there's significant demand from short sellers to bet against it despite the astronomical cost. The estimated float for WLDS is also quite small, at just 1.9 million shares, which means there are not many shares readily available for trading in the first place. When a small float meets high demand is short, you often see these kinds of elevated borrow fees. While the exact number of shares currently available to borrow is unknown at this moment, the CTB percentage speaks volumes. Our internal composite squeeze score, which factors in metrics like CTB level, float size, and price momentum, currently stands at 52.0 for WLDS, signaling a notable, though not extreme, squeeze potential. Squeeze mechanics explained. So, what does it mean for a stock to squeeze? A short squeeze happens when a stock's price starts to rise, often unexpectedly, forcing short sellers to buy back shares to limit their losses or meet margin calls. This buying pressure then pushes the price even higher, creating a snowball effect as more short sellers are forced to cover. A high cost to borrow like we see with WLDS can accelerate this process, because the daily cost of holding that short position becomes so painful that short sellers are incentivized to close their positions much faster, especially if the stock price starts moving against them. However, it's crucial to remember that a high CTB does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the price will ultimately fall, and they are willing to pay a premium to maintain that bet. Dilution risk check. One critical factor that can negate even the most promising short squeeze setup is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically dilutes the value of existing shares and can provide an easy source of liquidity for short sellers to cover their positions, effectively removing squeeze pressure. For WLDS, we've thoroughly checked recent SEC filings and found no recent dilutive SEC filings, such as -1s, -3s, or 424BS within the last 90 days. This is a positive sign for any short squeeze thesis, as it means there isn't an immediate threat of new shares flooding the market and potentially undermining any upward price movement. Recent reverse split watch. Another important piece of context for WLDS is its recent reverse stock split. The company executed a 1-4-3 reverse stock split on June 22, which was 43 days ago. A reverse split reduces the number of outstanding shares and increases the price per share proportionally. For example, if you own 3 shares at $1 each, after a 1-for-3 split, you would own 1 share at $3. This reduces the overall float, potentially making shares even scarcer. Historically, many microcap stocks tend to see renewed volatility or a price pop within about a month after a reverse split, as the market digests the change in share structure and price. While WLDS is now slightly past the typical 1-month window of 43 days, this recent event is still relevant context for its current market behavior. It's a pattern we've observed in some names, not a guarantee, but worth noting. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's look at the recent price action for WLDS. Today, the stock is up plus 6.71%. Over the last 5 days, it's gained plus 7.7%. In looking back over the last 30 days, WLDS has seen a significant move, up an impressive plus 68.25%. Chart highlighting 30-day gain now. Let's consider the volume. Today's volume for WLDS is 400,500 shares, which is quite low compared to its 30-day average volume of 2,778,233 shares. This gives us a relative volume of just 0.1x its average, meaning today's trading has been very quiet. This low volume, coupled with a small float and high CTB, can sometimes lead to sharp price movements on relatively little buying pressure. Key things to watch for with WLDS will be sustained high cost to borrow, any data indicating a shrinking supply of shares available to borrow, and any significant uptick in volume on strong upward price movement, which could signal short covering accelerating. In conclusion, wearable devices limited WLDS presents a unique case with its extremely high cost to borrow of nearly 950%, a tight float, and the recent context of a reverse stock split. While these factors create an environment where a short squeeze is a possibility, always remember that high CTB is an indicator of pressure, not a guarantee of a squeeze. Short sellers might be deeply convinced in their thesis. It's crucial to conduct your own due diligence and understand the risks involved with highly volatile microcap stocks. If you found this analysis helpful, please hit that like button, subscribe for more in-depth stock breakdowns, and let us know your thoughts on WLDS in the comments below. We love hearing from you.